prices declined, not 30%, but they declined 70%. And very few people went bankrupt. Why? Our friends, they own Sungunkai properties. Well, the company is a developer of properties. They have a gearing of maximum 25%. Everything else is cash. I have friends in Asia that own property companies, family companies. They never borrow a penny. They build a building, and when the cash flow is large enough from that established building, then start the next one. And so we have low leverage in Asia. In America, we have a lack of savings and we have high leverage. And this is the problem. If you look at homeowners' equity, and this is what I relate to a change in society. In the 1950s, homeowners' equity was 80%. You know, if someone bought a house for 100,000, he would pay down 80,000 and borrow 20,000. In the 70 crisis, 73, 74, and 81, 82 crisis, homeowners' equity was still 70%. But now it's 43%, and since 33% of homes in the U.S. are fully owned, in other words, they have no mortgages, it means that 67% of homes have 15% or less equity. That is the problem. It's not the problem that home prices went down. The problem is that there was too much debt, and that Mr. Bernanke and Mr. Greenspan never acknowledged.
But having never acknowledged that, let's just agree there for a moment. Having never acknowledged that, are times changing, or are we still in a situation? For example, you write about one homeowner who had $40,000 in equity to purchase a house that was worth $740,000. I mean, now that house worth maybe $450,000. Is anything different now?
Well, I think that people now wake up, because, first of all, the baby boomers are now beginning to retire. So the population 65 years and older is exploding starting now in the next 5 to 10 years. And when people start to retire, they have essentially, they live off their pensions. And what they have also less spending requirements. The big spenders are the people age 25 to essentially 40, and the baby boomers until the late 50s. But after 65, people spend somewhat less money. And so I think that consumption in the U.S. will not return to the peak levels of the artificial boom that we had when housing went up and people could refinance their homes and take money out of their homes and go and spend it on a new Mercedes. That, I think, is gone for the time being.
Now, will these new retirees or people that are looking forward to the time of retirement, are they going to face a more volatile financial time as well?
Well, I mean, the problem is, let's say, if you were to retire today, you're 65, you have $2 million in cash. Well, you can't retire on the $2 million in cash because they don't give you any return. The interest rates are zero. So you have to buy probably municipal bonds, and then the quality issue becomes an issue, or you have to buy corporate bonds, or you have to buy equities. And that's why the equity markets have gone up so much, because people realize that cash is trash. I mean, cash will be good from time to time. Like in 2008, cash was better than to own equities and commodities. But by and large, going forward for the next 10 years, when you read Mr. Bernanke's statements and you read also other economists like Mr. Mankiff of Harvard or Mr. Krugman, I can bet you that interest rates on the short end, in other words, the Fed fund rate will stay below the rate of inflation for as far as the eye can see. Because one thing that will have to happen is someone will have to finance the fiscal deficit of the U.S. And I don't think for a minute that the fiscal deficit will go much below $2 trillion annually.
So does that spell a very hefty bout of inflation, or at least inflation when you look at the value of the U.S. dollar versus other currencies around the world?
Well, basically, inflation is largely reflected in the weakness of the currency. And so we can say that since 2001, the dollar has been weak, in particular, obviously, against gold, and that is a symptom of inflation in the system. Now, it doesn't necessarily have to be in the price of a mobile phone, because there is technological innovation, and first it's a new invention, and then it becomes a commodity, like the first calculators, box calculators, were expensive, and then the next ones they gave away when you bought an airline ticket or a lottery ticket and so forth. So the products, they become commodities eventually. That is not deflation. That's just a typical part of the new product cycle. But I think, yes, we will have higher inflation. We'll have a lot of financial volatility.